Hey, this is Nick with Supportive Financial, and today I want to talk about the potential 10-year tax monster if you inherit a 401k or an IRA after 2020. So they changed the rules in 2020 for when you need to withdraw from an inherited IRA. And if you don't do the proper planning, you could be faced with a lurking large tax monster 10 years from now. So let's dive in to try to avoid this lurking monster. So if you inherit an IRA or a 401k after 2020, you need to first ask yourself, am I a eligible beneficiary or just a regular named beneficiary? Now, if there's no beneficiary listed, there's a whole different set of rules. But for now, let's assume that there is a named beneficiary on the IRA that you're inheriting. A designated beneficiary needs to follow the 10-year rule. An eligible designated beneficiary can follow either the 10-year rule or spread out the withdrawals from the inherited IRA over their life expectancy. Now, a surviving spouse has even more options. But for today, we're going to go through if you are a named beneficiary and you are not an eligible designated beneficiary, what is the 10-year tax monster if I'm subject to that 10-year rule? So what's the 10-year tax monster? Let's picture you inherit an IRA in 2024 and the person was taking required minimum distributions. Well, the first thing is that if they were old enough to be taking required minimum distributions, you first have to satisfy their final year RMD in the year of death. After that, you have two responsibilities. One is to take a portion of the inherited IRA, withdraw that based on your life expectancy, and withdraw the full funds of that IRA by the 10th year following the year of death. So let's look at what a 10-year tax monster would look like if you did no planning prior to that 10th year. So just taking some round numbers here and saying that if the year of death was 2024, and then for the next 10 years, you did nothing. All you did was take a small portion out of the IRA, the bare minimum that you were required to do. By the 10th year, the government's going to say you need to withdraw that full IRA account. And here comes the 10-year tax monster. It is going to potentially increase your taxable income substantially. Now, what is the problem with having increased taxable income? Well, based on our system, you could be paying a higher percentage of taxes. You could be blasted out of different phase outs for contributions, credits. Having extra taxable income can really affect things. It could affect your Medicare premiums. So having a one-time 10-year tax monster really could be a scary thing. So let's look at what is the alternative to the 10-year tax monster. So even though you might be required to take the funds out by the 10th year, you can also choose to be more aggressive with your withdrawals and smooth out your income over time. So instead of waiting to the 10th year to withdraw the full funds, maybe you accelerate those withdrawals throughout the 10 years to help smooth out that income. Now, what are some other ways that we could smooth out income? Well, if we're going to be withdrawing from an inherited IRA, and if you're working, maybe at that point we're also maxing out our current employer 401k. Or if we have a year of income where all of our other income sources are lower, maybe we accelerate withdrawals from the inherited IRA. So we really want to avoid that 10-year tax monster and create more of a smooth out tax monster. Hopefully you found this video helpful. Please don't be afraid of the 10-year tax monster. There is proactive planning that can be done to help smooth out your income taxes. As always, I'm available. I can help you determine what type of beneficiary you are and also help you navigate the different required minimum distribution rules for you. Take care and thanks for watching. Bye-bye.